Thank you, Shobji. Hello, everyone. Good morning. I hope all the participants have joined in. If please can confirm in the chat box quickly so that I get to know. We can wait for 2 seconds before we actually start so that if anybody is still joining in, they can join in and then we can start. 10-15 seconds. So I hope your preparations are going good and you are doing the revisions after all these classes which are conducted by the institute. Okay, so let's start. So the agenda for today's session is, to do the revision of India's 102, right? Share-based payments. So I hope you must have already studied this India's. So what we will do a quick recap, what all the standard is, talking about and what accounting we need to do for these share-based payment transactions. And, thereafter we will cover up or test our knowledge on some of the MCQs, and we will do some, full-fledged practical questions around this standard just to crystallize our concept. So that's the plan for the day. Okay. So what's the share-based payment? What did we understood so far? Which all types of transactions, are regarded as the share-based payment? Any guesses? Are you able to recall? So basically, the standard covers, all those. Yes, please go ahead.
Shares given to employees for their services, ESOPs basically, or to third parties for their services.
Okay.
Or
So
cash.
you are saying that ESOPs as well as with other parties, right?
Yes, sir.
Okay, correct. So that's what the standard is also talking about. So there could be only two scenarios. So let me start with an example. For example, there is a company A Limited, right? Now A Limited either could do a transactions with its employees, right? Right. So what transaction A Limited is doing with its employees? So A Limited is hiring the employees, right? Agreed upon to pay a fixed, salary or wages to those employees. And in turn, these employees are providing their employment services, right? Full-fledged employment services to A Limited. This is the one transaction, right? And the other transaction could be with third party, right? Other parties, right? Who's these other parties could be? Either they could be the suppliers of raw material, right? They could be the suppliers of or PP&E, right? Or they could be the supplier of any other, purchase of goods, right? Or any other goods, correct? So all the transactions which the company is doing for any sort of purchases of the goods or any of the PP&E, fixed assets, or any other, items, right? As well as supplier of any services, right? Yes or no? For example, legal, consulting, right? Marketing, or anything else, right? Anything else, right? So third party either could supply any of the goods or the fixed assets, right? Or any of the services to the entity. Now, entity A Limited, instead of discharging its obligation in terms of cash, right? What they have agreed upon that either they will pay the price, right, for to its employees as well as to these third parties, either in the form of equity shares, right, of its own, that is of its A Limited, or the equity shares of the parent of A Limited, right? Sorry. Give me a second. Is the screen visible? Or the shares of A Limited, either the shares of A Limited, that is itself, or the shares of its parent company is happening. Give me a second. I'm just resharing the screen. Right? So A Limited, right? So A Limited could discharge its obligations either in the form of equity shares of its own, right? Or in the form of equity shares of parent, right? Or in the form of equity shares of any group company, right? Right? For example, if I turn around this example with, say, Tata Group. So TCS is the company, Tata Consulting Services, right? So TCS is coming up with, discharging its obligations towards its employees or towards any of the third-party vendors for any supply of goods or services or the PP&E in the form of equity shares of TCS itself or equity shares of Tata Sons, right? Or equity shares of, say, any of the group company, for example, Tata Steel, right? So that's what the standard says, right? So if the entity agrees upon to discharge its obligations towards employees or towards third parties in lieu of their services being provided to the entity by either issuing the equity shares of its own or the equity shares of its parent company or the equity shares of any other group company within the said group, right? So then those transactions are covered by Ind AS 102. Now, the standard further extends and talks about either the entity can issue the equity shares, right? Or it can pay the cash equivalent to the fair value of these equity shares, right? So instead of actually giving the equity shares itself, what they can do, they can, instead of issuing the equity shares, they can also pay the cash as well, right? But that cash, how much cash will be paid, that also depends on the equity shares value, right? How many number of shares we have agreed upon. So the prima facie, the arrangement says that 5,000 shares will be issued. But instead of issuing the 5,000 shares, I am just paying the cash equivalent to the value of those 5,000 shares, right? Then these transactions are regarded as share-based payment transactions, right? Because these transactions are being discharged basis on the shares or basis on the shares value, right? So if the agreement doesn't talk about any shares, then those transactions will not be covered by Ind AS 102. The standard is very clear. Only those transactions which requires entity either to issue the shares or to discharge in cash or other financial assets, equivalent to the value of those shares. Then only these transactions will be covered, right? If this is the agreement, then this agreement is called share-based payment arrangement, right? SBPA. Now, when the company enters into transaction with its employees, right? So anyway, company is paying the salary, right? Bonuses or any other, benefits in cash, which are already taken care by Ind AS 19, right? Short-term employee benefits, long-term employee benefits, termination benefits, and retirement benefits, right? So all these benefits are already taken care by Ind AS 19. The only benefit which is being paid in the form of shares will be covered by Ind AS 102, and that benefit we generally call by the name ESOP, right? Employee stock option plans, right? So I'm not going to say that standard covers the ESOP transactions only. Standard cover any other transaction as well with the employees wherever the payment is being agreed to discharge in the form of shares, right? So either it could be the ESOP or it could be the ESOS, right? Or it could be the employee stock option plan, employee stock option scheme by whatever name called, or it could be, SARs as well, share appreciation rights, right? So generally what happens in case of SARs, company agrees upon to, pay the differential in the price of the shares from the grant date till the exercise date to the employees instead of actually issuing the shares and crediting the shares into their demat account, right? So those are called SARs, share appreciation rights, right? So this is prima facie the scope of this standard. Any doubts on the scope of the standard? So I assume there are no doubts or questions on the scope, right? So SAR is the share appreciation rights, right? So generally what happens, for example, if there is a grant date fair value of the share is say rupees 100, right? And the exercise date fair value when the employees actually entitle these shares, right? So vesting date basically, when the employees can come and ask for the shares once the shares are vested. Suppose the fair value of the shares is say 270, right? So instead of issuing the shares, what company can do? They can simply deduct 120 from the 270 and the delta, right? 150 will be paid in the cash, right? But how this 150 is arrived, that is all dependent on the fair value of the share, right? So that's why these transactions are regarded as SARs, share appreciation rights. So how much appreciation is there in the value of the shares will actually be paid to employees in the form of cash rather than issuing the shares itself. Is that clear? And not only to employees, it can be, with other third parties as well, right? So there could be arrangement with the employees as well for the SARs, and there could be arrangement with the third party as well for the SARs, right? So it all depends, what is the nature of the arrangement, right? Irrespective of the party, right? So that's the scope basically. Now, there are certain key terms which we all are familiar with, but still we should revise. So the exercise period is the period during which options can be exercised, and if not exercised, they will be lapsed, right? So, for example, let me showcase with this diagram. Suppose this is the grant date. For example, this grant date is say 10th of August, right? 2024, right? So on 10th of August 2024, company has come up with some employee stock option plan, right? And on this date, they are informing the employees that from now onwards, right, if you complete the 3 years with the company, right, from the grant date, if you complete the 3 years with the company, then you will be entitled to 100 shares at the end of the third year, right? So from grant date, year 1, year 2, and year 3, these 3-year period would be regarded as the vesting period, right? Over which the employee will earn the right to demand shares from the company, right? If they are staying with the company for these 3 years. So year 3, vesting, by year 3, vesting period will be over, right? Now here, suppose there were 150 employees, right, at the grant date, and out of 150, only 120 employees are still staying with the company, right? Then for how many employees the right will be vested? Only for 120 employees, because 30 employees have already left in between, either in year 1 or in year 2, or before the completion of the vesting period in year 3, right? So they did not meet the terms and conditions of the vesting period, complying with the staying with the company for 3 years. Hence, their options are not vested. So they got lapsed. Now, in year 3, for 120 employees into 100 options each, right? So how many total number of options will be vested? 12,000, right? So 12,000 is the number of options or number of shares which will be vested on this vesting date, right? And now the company says from the vesting date, there is a 1 year, right, time frame by which employees have to, inform companies for, demanding these options or the shares, right? If the employee doesn't exercise this right within this time frame, right, then these exercise rights will be lapsed, and hence thereafter employees will not be able to make any demands. So this period from the vesting date till the exercise date, right, this period is called exercise period, right? Correct. So this is the exercise period, right? This is the vesting date, by which date the employee gets the right to ask for the shares or the options. And this is the grant date, when the company has come up with the plan and communicated the terms and conditions of the plan to the employees, right? And employees have understood the terms and conditions, right? So grant date is the date at which the entity head and the counterparty have a shared understanding of the terms and conditions of the arrangement, right? So employees are communicated that they need to stay with the company for next 3 years in order to earn the right to exercise for these 100 options, right? And the date by which the exercise period is getting over and the date of the vesting date, this period will be regarded as the exercise period, during which employees can exercise their right to ask for the options, right? So this is the basically the term chart, which is generally used in this standard to come up with the calculation of the expense and the liability for each year, right? Now the standard comes and says there are two types of share-based payment plans in principle, right? One is the equity-based, other is the cash-based. Equity-based are those plans where the shares are being, offered. Shares are being issued and offered to the employees or the other party, third party, as the case may be, right? So these are called equity settled. Means the transaction will be settled by issuing equity shares, right? Is that clear? So in equity settled, we will always settle the transaction by issuing the equity shares, right? In cash settled, we will discharge the obligation or settle the transaction, right, either by issue of equity shares or by cash, right? But in certain cases, the amount or number of shares will eventually be issued, will depend on the future value, right? So in it, the entity acquires goods or services by incurring a liability to transfer cash or other financial assets to the supplier of those goods or services for amounts that are based on the price or the fair value of the equity instruments, including the shares or options of the entity or any another entity which is falling within the same group, right? So these are called the cash settled, because here the transaction is getting settled on the future fair value of the equity shares by giving or offering the cash or some other assets, right?
But
Now there is a
not by equity shares, sir. No, this cash based is not by equity shares in any case.
right. So in this, it is either in cash, right, or other assets, right?
Yes.
Here it is by issuing equity shares, right? Equity shares, right? Now there is third category as well, where it is not clear on the grant date whether the transaction will be settled in the equity shares or whether the transaction will be settled in cash, right? So in that case, what will happen? We call this as share-based payment transaction with cash alternative, right? So share-based payment transaction which provide the counterparty, that is the employee or the third party, as the case may be, with the choice of the settlement. And this choice he or she can make either at the beginning or during the period or at the on the settlement date, right? So they carry a choice whether they want to ask for a cash or whether they want to ask for the equity shares of the company, right? So they have the choice because they have not yet decided upon which choice they are going to make. Hence, the company is under obligation to either pay cash if they choose cash or to pay equity shares, basically offer equity shares or issue equity shares if they choose equity shares. But today, the company doesn't know which choice they will make eventually. And hence, these transactions, carry some uncertainty in the form of mode of settlement, right? So that's why they are regarded as the share-based payment transactions with the cash alternative, right? In this case, they can share-based payment transactions which provide the entity with the choice of settlement. So what is happening over here? Either the employee, right, or the third party, other party basically, right, has this choice, right, or the entity also can have this choice, right? Now, in both the scenario, if this is not yet decided on the date of the arrangement that which choice is being, opted or then we will continue with the uncertainty of a choice, right? The choice is lying either with the third party or the employees or the entity itself. Now, when the choice is with the entity, although we can certainly believe that entity knows which mode, they are going to settle this transaction. But if that is also not yet concluded or decided by the management, then in that case as well, this transaction falls in the third category. Now, if this choice is decided and agreed upon on the date of the arrangement itself, then either this transaction will fall in the first category if the equity share is decided, or in the second category if the cash is decided, correct? But unless and until it is decided, it will continue to be sitting here in the third category, the share-based payment transaction with the cash alternative. Is that clear?
So the entity will have a choice to decide only when the third party does not exercise its right to decide.
Correct. No. So it can't be with the both parties in at the same time. So either the choice will be with the third party, that is the employees or the supplier, or the choice will be with the entity. It can't be with the both, because if it is with the both parties, then other party is asking for cash and the entity decides to pay in equity shares, then there will be dispute, right? So it could be either of the situation, right, at one time. So in one particular arrangement, either the choice is with the third party or the choice is with the entity, right?
Yes, sir.
Perfect.
Perfect,
Any
sir.
other questions until now? Okay. So we have understood the scope. We have understood the fact that either the company is offering the shares of its own, or the shares of its parent company, or the shares of any other group company to discharge its obligation. Whatever is agreed upon could be classified into three categories. If the company has agreed upon to discharge the equity shares, it will be treated as equity settled. If the company has agreed upon to discharge the cash in lieu of fair value of the equity shares, then it will be cash settled. And if this is not yet decided and to be decided in future, maybe near around on the settlement date, either by the other party or by the entity, right? Then it will be regarded as the share-based payment transaction with alternative cash, right? Cash alternative, right? We will do the practicals for all these three approaches, how we are going with the calculations as well as the accounting and the journal entries, right? So just bear with me for some time. Now, what would be the accounting in case of the share-based payment transaction? So there could be one side debit, right? So we will debit the expense, right? And there will be another side credit. We will credit the liability, because on the day one, neither we are, offering or discharging any obligations, right? So we will record a liability. Until the obligation is discharged, the liability continues, right? So in case the share-based payment arrangement is equity settled, right? In that case, how this liability will be recorded? By crediting the. So what we will do? We will create a notional account by whatever name you want, maybe share based payment transaction equity reserve account. Okay, so we can call this share based payment transaction equity reserve account, right? And this account we will continue to credit for recording all the equity settled transactions. And in case the transaction is the cash settled, right? In that case, what we will do? We will record a liability. So what the name we can give? Equity cash settled liability account, right? Cash settled liability account, we can create a notional account for the purpose of easy identification and demarcation of these arrangements, right? So this is how we are going to record the entries, and the debit will always be the expense. Expense means OCI or PNL, whatever. We have a free choice, right? No, always PNL, right? No OCI. Okay, so always PNL we will debit for these expenses, right? Then the standard says on what date we will measure the fair value, right? On what date we will recognize these transactions in our books of accounts, right? And what would be the basis of the measurement? So for equity settled transactions, when the transactions are settled with employees, category 1, and when the transactions are settled with parties other than employees, right? The third parties, supplier of goods and services, or the PP&D, category 2, right? So in this case, the standard says how the transaction will be measured, right? At what value the transaction will be measured and recorded. So in case the transaction is with employees, then we will simply compute the fair value of the equity shares granted, right? And which will be the date on which the fair value will be computed? The grant date, correct? Which will be the date when we recognize the date on which the goods and services have been received. Now, what do you think? In case of employees, on which date you will record the expense in your books of accounts for these arrangements? On which date you will say that, yes, we have received the goods and services from the employees? So basically, of course, there are no goods, there are services only, employment service. So on which date you will conclude that services are received? What do you think? So it will be on a daily basis, right? Yes or no? Yes. So employees are serving the organization by coming to office and picking up the office work as allocated to them, right? On a daily basis. So should I do the accounting on a daily basis? No. For the convenience, what I can do, I can either record this expense on a monthly basis, right? Or on a quarterly basis if I need to prepare and report my P&L picture on a quarterly basis. And if not both, at least on annual basis. Yes or no? Correct? So if I'm reporting my financials on a quarterly basis because I am a listed company, then I will, record this entry on a quarterly basis as well. Otherwise, I can simply continue with the annual recording of this expenditure, right? So that is for the convenience. Standard doesn't talk about that. Standard simply says that as and when the services are received, the expense needs to be charged in the P&L, correct? And the expense will be valued at grant date. That is the date on which the plan has been constructed and communicated to the employees, right? And fair value of equity shares will be measured on this grant date. So this is the mechanism for the employees, correct? Now, for other parties, fair value of the goods and services received if it can be estimated reliably. So, of course, we are receiving the invoice for which actually states what is the value of these goods and services. If we are buying any machinery, if we are buying any raw material, or if we are taking any marketing legal services, generally these guys are sending us invoices for their value of services. So that value will be treated as the fair value of those goods and services, and hence the transaction will be measured at the fair value of those goods and services only prima facie. But if the management comes and says that the service or the good which we have received cannot be fair valued, right? We do not know what is the value of those goods and services, then in that case, we will do or adopt an indirect method to do the fair value. And now in that case, we will say the fair value of the shares, offered to the party will be taken as a basis for the measurement of this transaction. So in case that assumption is repeatable, right? And on which date we will measure the fair value? The date on which the goods and services are received. So received means what? GRN is done or what? So for goods, when the goods are received and by the company, and they have gained the risk and reward of those goods. And in case of services, the services are delivered by the supplier. So let me take an example of services, right? For example, we have the management has connected with, say, Hindustan Times, HT Media, right, to publish a advertisement in the newspaper, right? In the newspaper about the products of the company, right? They want to advertise. Now, on which date you will say that services are received by the entity? So, will it be the date on which this agreement has been made? Will it be the date on which HT Media, raises the invoice to the company? Or will it be the date on which the company is entitled to make the payment? Or will it be the date on which the advertisement is published in the newspaper? What do you think? What do you think?
Whenever it is published in the newspaper.
Correct. So services received means that services are delivered by the other party, and the utility of those services is derived by the entity. So utility of those services are derived only when those advertisements are actually published in the newspaper, right? Suppose if the advertisement was published on, say, 15th of March, then 15th of March would be considered as the date on which the services are received, and hence on that very date, we will measure the fair value, right? So we will measure the fair value of the services, right, basis on the fair value of those advertisement or fair value of shares if we say that we are not able to measure the fair value of those services, right? So this is how the standard is talking about to do the measurement of these services which we are receiving from these two types of parties and on these very dates, right? So the date on
So,
which we are
so in this case, like we have said that the invoice value will be the fair value if it can be taken reliably.
correct, correct. So prima facie, always the invoice value will be considered as the fair value of the goods and services, right? But in case, suppose the company says we do not know the fair value of the goods and services, right? In that case, we will measure the fair value of the equity shares which we are going to offer, right? So that
So
is only when
this,
you come up
this is
with
an
the
exception. The example you gave is an exception.
yes, this is an exception only. And for this exception, the management has to justify it why they are not able to, measure the fair value of the goods and services they receive, right? Although in practical life, there could be, one or two such scenarios, but not many, right? So if some services, is of really new in nature, never delivered in the past, right? Some sort of new service, right? So they are the supplier is not ready to come up with the right amount, but they have agreed upon to take say 100 shares. Then we will say okay, so if they are okay to receive the 100 shares, then probably the fair value of the 100 shares will be considered as the fair value of that service which eventually the company is receiving from that supplier, right? So this is other way around. Ideally we will do the invoicing, consider the invoicing value only as the fair value. Is that clear?
Yes, sir.
Okay. So we will do some practicals, right? So maybe we can just try once this question quickly, how we are good with the calculation part, right? Because at the end of the day, we have to come up with the right amount of the expense we are going to record in these 3 years in the P&L and the liabilities, right? So we need to understand that first. So let me take this example quickly. Borealis Limited offers 400 shares to each of its 1,000 staff if they stay with them for 3 years, right? The fair value of the shares on the date was rupees 50. At the end of the year one, 20 employees have left, and the entity estimates that total 25% will leave during the vesting period. During the vesting period means during the period of 3 years. In the second year, a further 20 employees left. The entity further revises its estimates of the total departures of from 28% to 28%. So by 3%, they have increased the expected departures. In the third year, 20 employees left. Determine the amounts to be recognized in the P&L over the period of 3 years. So you just need to come up with the expense amount for the year one, year two, and year three. If you want to quickly try your hands on this. You can just simply punch your answer in the chat box. Year one amount, year two amount, year three amount. I don't think the calculation should take so much time. Unless and until you are not having the calculator handy with you. Yes, any answers? Please respond. So Ravi has come up with 486667. So what this amount is? Expense for the year 1, year 2, or year 3? What it is, Ravi? Acha, for year 1, okay. For year 2 and year 3, what would be the amount? So why I'm asking you to do the calculations? Because if you do the calculations and suppose if you make any mistake, then you will realize what mistake you did, right? But if you do not perform the calculations or practice enough, then probably, it would be difficult to come up with the right answers in the examination. So for year 2, you are saying 42 lakhs and 973333 for the third year. Okay. Okay, so let's see how we are going to perform the calculation. So that is, very crucial in this standard. So if we make any silly mistakes in the calculation, everything will go on toss. Okay. Even if we know all the concepts of the standard, but calculation mistake will take away all the marks, right? And I am telling you this is if the practical question comes from this standard in the examination, right? I have never said this before for any other standard, but I'm specifically talking for this standard. It is the easiest standard and the most scoring standard among the all, because it is all dependent on simple straightaway calculations. So if you are good with the calculations logics, you will, get the good marks, and in no time you will be able to solve the numericals of this standard, right? So fair value on the grant date, 400 into 1,000. So 400 is the number of employee, 1,000 is the number of shares for each employee, 50 is the fair value on the grant date, right? Grant date fair value. Correct? So the total amount comes how much? This 20 million, right? Now, we need to calculate always cumulative charge, right? So just make a note of somewhere that whenever you are going to do the calculations, you have to do the cumulative calculations. So for year 1, this total amount into 75%, right? Because the management believes that by the end of the third year, that is by the end of the grant vesting period, right? All in all, 25% employees will leave, right? So it means 75% will stay. So for that many employees, which will actually stay with the company, we will compute the charge. So the total charge into the 75% of the employees, which we are expecting to stay, into 1/3, right? Why 1/3? Because we are calculating the expense for the year 1 and total period over which the expense needs to be recorded in the P&L is 3. So 1/3, right? So this would be the amount. For the second year, again, the total charge into revised estimate of the management, right? Now the management believes only 72% employees will stay. Basically, they have increased their estimate from 25% to 28%, right? So more employees will leave, so lesser employees will stay. So hence, we are going to revise our calculation. So we'll say for 72% employees only, we will compute the amount. Now for year 2, what the factor we will say or use? 2 by 3, right? Because it is year 2, right? And divide by 3. So the cumulative charge we have to calculate. We can't simply say that 1 by 3 for year 1, 1 by 3 for year 2, and 1 by 3 for year 3. No, we have to do the calculation cumulatively. 1 by 3 for the year 1, 2 by 3 for the year 2, and 3 by 3 for the year 3, right? Now the total expense, cumulative expense is how much? 96 lakhs. 50 lakh has already been recognized in the year 1 in the P&L. So the remaining 46 lakhs will hit to the P&L for the year 2, right? And in the third year, finally, 940 is the number of employees which actually stayed with the company, right? 50 is the number of options, right? So, sorry, 400 is the number of options and 50 was the fair value. So the total expense for all the 3 years comes 18,800, right? Now, out of this, 50 lakhs and 96 lakhs, we have already charged to our year 1 P&L and year 2 P&L. So the remaining balance of 92 lakhs only will hit to the P&L in the year 3, right? Is the calculation logic clear to everybody? How we are going to do the calculation? Yes or no? Now the question comes that what to do with the information which the question had about the number of employees left in the year 1 and number of employees left in the year 2, right? Now let me pick that up now. So question says in year 1, 20 employees have left, but the management believes at the end of the vesting period, 25% employees will leave, right? So how many total number of employees we have on the day 1 is 1,000 people, right? So 1,000 into 25%, right? How much it comes? 250. So management is saying by the end of the vesting period, 250 employees will leave the organization. But in year 1, 20 employees have left, right? So because we are not going to perform the calculations for, basis on the number of employees left, we are doing the calculation basis on what would be the final number of employees at the end of the vesting period who will be staying with us, right? So that would be how much? 750 employees, right? So only for these 750 employees, we are going to, calculate the charge, right? And because this 250 employees is greater than 20 employees, right? So we will consider that. Suppose I tweak the facts of this question. Instead of 20 employees in year 1, 260 employees leaves, right? In that case, what will happen? Our calculations will be revised. Now, because management says that 25% employees will leave, right, on the date of grant by the end of the vesting period. But as and when the first year is completed, we notice 260 already left. 260 means greater than the 250 which was projected by the management. So, and hence, now, basis on the actual number, we will calculate the expense. Now, in that case, how the calculation will happen? So, we will say 940 employees into 400 shares into 50 rupees into 1 by 3. In that case, this is how the calculation would have performed. But because the number of actual levers is less than the projected levers by the end of the vesting period, so we will continue to stick with the projected number of levers in our calculations. Is that clear? Ravi, I answered your question, right? There might be, other people also who would be having this doubt. So can I ask everyone if this point is clear to everybody, how we are actually doing the calculations in this case?
Yes.
Thanks for the confirmation. Okay. Because I know practice is essential. So let's do one more question. Omega grants 120 share options to each of its 460 employees. Each grant is conditional on the employee working for Omega over the next 3 years. Omega has estimated that the fair value of each share option is INR 12. Omega estimates 25% of the employees will leave during the 3-year period. So forfeit their rights to the share options. Everything turns out exactly as expected. Calculate the amounts to be recognized for the services received as a consideration for the share options during the vesting period of how many years? 3 years, right? So just come up with the amount of expense for each of the year 1, year 2, year 3. $165,600 Ravi has said for the year 1 or year 2 or year 3. Each year. Okay, so you are saying the expense amount is same for each of the 3 years. Okay. So this is how the calculation will be done. So how many options are there? All in all, 55, 200 options, right? Now in this question, because there is no fact or data around the actual levers, right? The only assumption is 25% of the employees will leave, and at the end of the 3rd year, 25% employees only have actually left as well. So there is no change in the number of employees throughout the vesting period, and hence the amount of expense is coming, same for each of the 3 periods. Is that clear? But still, the calculation will be done in a cumulative manner only. So we will apply the weights 1 by 3, 2 by 3, and 3 by 3. So 1 by 3 is straight away the expense amount comes 165,600, and when we applied the weight 2 by 3, the expense amount is 331,200. Now out of this expense, how much we have already charged in the year 1 P&L, we will be deducting in order to arrive at the year 2, right? So don't assume because just the answer is same or the amount of expense is same for the 3 years, we are not applying weights. We are applying weights in this case as well, but those weights are redundant because of the facts of the question. But still we will continue with our approach of calculating the expense for each of these 3 years by applying the weights. Is that clear? Clear to everybody? Okay. Now, so this we have talked about on the equity settled transaction, right? Now, the cash settled transaction, how they are going to be measured, how they are going to be accounted for in our books, right? So, for the cash settled, initial measurement will be done. The entity shall measure the fair value of the goods and services acquired and the liability incurred at the fair value of the liability, right? So, initial measurement will be done, of course, on the grant date, and it will be, remeasured on each reporting date, right? So if the reporting date is the quarterly, because the company is listed and they are going to produce their quarterly results, then for each quarter, it will be revalued on the fair value of those shares as on the quarter end date, right? If the company is not listed and they are only preparing annual financials, in that case, they can remeasure this liability on the annual basis as well, right? So that is the flexibility we have. Standard doesn't talk about when you need to, do this. Standard only says for each reporting date, you need to come up with the reinstated liability, right? Now, remeasurement will take place unless and until the liability is discharged, right? So until the liability is discharged or settled, the entity shall continue to remeasure the fair value of this liability at end of each reporting period and the date of the settlement. And whatever is the change in fair value will be recognized in the profit and loss for that particular period. Is that clear? So for cash settled, because cash settled transactions are in the nature of liability, so we are recording these as liabilities, right? And liability always needs to be fair valued at each reporting date. So that's why we need to do the fair value of these liabilities on each date, because share price, if is fluctuating, then basis on that our liability amount will also change. But in case of equity settled, right, we are not going to make any reinstatements, because in equity settled we only discharge the equity shares and the number of shares will continue to remain same over the life, right? So if it is agreed that we will offer 100 shares to each employee, then it will be 100 shares only, which the company eventually will be crediting to the employee's demat account who are staying with the firm, right? But in the cash settled transaction, company is not crediting the 100 shares. Rather, they are paying cash equivalent to the fair value of those 100 shares. And because the fair value is fluctuating for the year 1, year 2, and year 3, and throughout the years itself as well, hence the liability has to be reinstated on each reporting date as and when we are preparing our financial statements. Is that clear? Right? Concept is clear. Any questions or doubts on this concept before we actually jump on to the practical around on this? Okay, thanks for the confirmation. Now, let's do one practical on this as well, just to crystallize this, how we are going to perform these calculations. So vesting condition is the 3-year continued employment with the company, right? And market-based performance conditions are also there, right? So assumption is 100 share appreciation rights granted on 1st of January 2001, right? Best estimate is that all employees will continue with the company or will remain in the service over the vesting period, right? So for the sake of simplicity, facts of the question says that there wouldn't be any employees who would be leaving the company in this period. Grant date fair value of each right is rupees 3, including the adjustment for the market condition. Now, at the end of the year 1, at the end of the year 2, at the end of the year 3, and on the settlement date, the fair values are 4, 4.25, 4.5, and 4. And the intrinsic value of the option is 1.5, 3, 4.25, and 4. Right? Now you need to calculate the expense amount for year 1, year 2, year 3, year 4. Right? Basically, not year 4, basically the settlement date. Right? And the liability amount, right? For the year 1 liability amount, right? What amount would be the liability and what amount would be the expense, right? Which will be hitting the P&L. So can you just do these calculations once on your own before we discuss the answer? So the question, I think there is some confusion. Somebody is asking how many is the number of employees. So 100 is the number of options which are granted, right? So even if we do not have the number of employees, the question says how many total uh, options are there or total share acquisition rights SARs are there. So it's 100, right? So basically, all in all, the total number of SARs are 100 for all the employees taken together. So we don't need the number of employee information, right? Because we are given the total number of SARs already. How many the total SARs are there? Yes. Any luck with the answer? Year 1 expense amount, liability amount, year 2 expense amount, liability amount, year 3 expense amount, liability amount. So Samanathan has come up with the answer. Year 1 rupees 100 debit to the P&L. So you are saying 100 rupees is the expenditure for the year 1. Okay. For year 2, you are saying 25 rupees is the expenditure. Okay. And year 3, you are saying 25 rupees. So all in all, you are saying 150 rupees is the total expense. Split it into year 1, year 2, year 3 by 100, 25, 25, right? And year 4, 50 rupees is increased, is credited to the P&L. Okay. So year 4, you are crediting the 50 rupees. Okay. So let's see how the calculation works out. So how the calculations are working? So current year expense, year 1 is coming at 133 rupees, right? So 133 would be the expense for the year 1. 283 would be the cumulative expense for the year 2, right? So 150, that is 283 minus 133. So 283 minus 133, right? For third year, it would be 450, then minus 133 minus 150, right? Would be the 167, right? And 50 rupees would be the reversal because of the fair value gain, right? Now we will see how the calculation is done. So for the year 1, how many number of options are there? 100, right? So 100 is the number of option, 100 into what is the fair value on the grant date? So the fair value on the grant date is 3 rupees, right? Into में 3 into what is the period? The total period is 3 years. So into में 1/3, right? So this gives us the value of 133, right? For the year 1, right? Then for year 2, how will we calculate the expense? So 100 again into में the fair value. What is the fair value in this case? 0.25, right? Into 2/3, right? So how much amount? How much is the amount coming? So it comes 283, right? And then I will deduct the year 1 expense 133, right? So this is how I will perform the calculations. Then for the vesting date, I will apply the fair value of the third year 4.5, right? And then finally, the settlement date value is 4 rupees, right? So settlement is happening at 4 rupees. So we are gaining. So here, third year expense, how it will be calculated? 100 into 4.5 into 3/3, right? So this will give me 450, right? 450 is the total expense, minus 133 I have already recorded, minus 150 I have already recorded. So remaining is 167, right? Now the 3-year expense is all recorded, right? So year 1 liability is 133, year 2 liability is 283, year 3 liability is 450. But actually the settlement is happening at 400 because in year 4, the settlement is happening at what value? 4 rupees, right? So in this case, 50 rupees is the gain which will be credited to the P&L. Is that clear? Clear? The
Yes.
calculation. Any doubts on this?
Sir, in the year 1, it comes to 100. How is come 133?
Yes. So I was just coming to that only because there has to be one doubt in this question, because in year 1, grant date fair value is 3 rupees, correct? But year end date fair value is how much? 4 rupees, right? So in this case, what actually should have happened? So on the date of the grant, first of all, we always calculate the expense and on the grant date, right? So on the grant date, we will take the fair value of rupees 3, come up with the calculation of 133, right? So 133 has to be recorded in the P&L for the year 1 for sure, right? Now, because at the end of the year when I am preparing my financial statements, and because this is a cash settled, so I will reinstate my liability at the end of the year 1 as well. So what I will do at 31st March or 31st December, as the case may be, I will recalculate the revalued amount. 100 into May 4 into May 1 by 3, right? How much this comes? 400 divided by 3, right? So this comes to 133, right? So it will be in the 2 steps, right? Sorry, I mistakenly said 133 here. Maybe it was 100, right? Now, the total expense for the year 1 is 133, but basis on the grant date fair valuation, it was 100. So initial entry would have been made basis on the 100 rupees, right? 100 into May divided by 3, right? But because my fair value is changed at the year end and I need to reinstate my liability, so I will make a revalued 400 divided by 3 is equivalent to 133. So for year 1, my total expense is 133. It can be recorded in a 2-step process, right? So first of all, if I'm recording my expense basis on my grant date calculations, because I want to post the entry, right? Instead of waiting for the fair value on the year end date, then I will consider the grant date fair value first, right? And thereafter, I will revise my estimate basis on the fair value of my reporting date fair value, right? So either the company can adopt this 2-way approach, or the company can straight away pass single entry at the end of the year itself. Clear? Clear?
Yes, sir.
Sorry, I did not get to ask something.
Clear, sir.
Clear. Okay. Right. So in practical life, if the company is preparing the financials on a monthly basis, they need to reinstate this liability on a monthly basis. If they are preparing financials on a quarterly basis, they need to reinstate the liability on quarterly basis because they are equity listed companies. If the companies are not equity listed but only debt listed, then by regulation, they have to prepare their financials on a half-yearly basis. So they will reinstate this liability on a half-yearly basis. And if they are not even debt listed, they have to mandatorily do it on annual basis at least, right? So standard doesn't say at which date you need to do the reinstatement. Standard only says at each reporting date, right? Whatever is your reporting date, you have to reinstate, right? And we will reinstate something which has already been recorded, right? And the already recording must have happened basis on the fair value of the grant date in year 1, and in year 2 basis on the reinstatement of the year one, right? So we will continue to reinstatement for each reporting dates once we start with the recording of this expenditure, right? Correct? Okay. Now, third category, share-based payment transactions with the cash alternative, right? So in this case, what happens? We need to calculate the debt component, we need to calculate the equity component, and then we will need to do the reinstatement of the debt component, that is the liability component, similarly like we are doing for the cash settle transaction, right? So this is how this arrangement will be accounted for. So we will understand this with one example. So before that, Ravi is asking, VP is to be considered for allocation of expense. What is VP? Sorry, I'm not getting what VP you mean to say. What is VP? Oh, vesting period. Sorry, my bad. So vesting period is to be considered for the allocation of expense, of course, because the entire expenditure has to be charged over the vesting period only, right? It cannot go beyond vesting period. And vesting period is the period over which the conditions are satisfied, which make the employees or the third party eligible to receive these shares or the cash equivalent to the shares, right? So that's the vesting period. So all the expense will have to be recorded over the vesting period. That's what we have done in the last three examples, right? Because the vesting condition was to stay with the company for next 3 years, so vesting period was 3 years. If the vesting condition is there for to stay with the company for 5 years, then vesting period would be 5 years in that case. Is that clear, Ravi? It's not about that we have to simply do the 1/3, 2/3, 3/3. So this 3 is coming from the vesting period only. So first of all, we need to come up with how much is the vesting period. It could be 2 years, it could be 1 year, it could be 3 years, it could be 4 years, 5 years, as the case may be, right? Right. So we are basically estimating the expenditure for the vesting period and allocating it on the vesting period. If it is 3 years, 1/3, 2/3, 3/3. If it is 5 years, 1/5, 2/5, 3/5, 4/5, 5/5. Clear, Saman? Samanathan? Okay. So let's understand this concept with this example quickly. And then we will have some MCQs and then full-fledged practicals. On 1st of January 2001, ABC Limited gives option to its key managerial person to take either the cash equivalent to 1,000 shares or 1,500 shares, right? So either they take the cash which is equivalent to the fair value of 1,000 shares or take 1,500 shares, right? So that's the choice available to the employees of the ABC Limited, right? So either the 1,000 shares cash value or the 1,500 equity shares. The minimum service period is 2 years. So in this case, what is the vesting period? Vesting period is 2 years, right? But the shares must be taken and kept for the 3 years, right? So there is a condition that even if the shares are awarded after the 2 years, they cannot be sold before the end of the 3 years, right? Now, share alternative fair value with restrictions is how much? 102. Grant date fair value on 1st of January 2001 is 113. Fair value on December 1, 31st December 1 is 120, and fair value on December 2, 31st December 2 is 132. The employee exercises their option, cash option, at the end of the 2002, right? Now, because on the date of the grant, the arrangement looks like hybrid, right? Either it will be settled in the cash or it will be settled in the equity. So it is neither the equity settled nor the cash settled. That is for sure, right? So it is the third category where the choice is available with the party, right? And that choice is not yet made. That choice will be made at the end of the period only, right? So we do not know which way it is going to be settled on the date of the grant at the end of the year one as well, right? Hence, we will consider this as a hybrid arrangement where there is a cash alternative available. Now, in this arrangement, we need to come up with the calculation of the expense for the year one, year two, right? Because the 2 years is the vesting period. And we also need to pass the journal entries. So should you want to try or should I discuss the answer straight away? What do you think? You want to give a try on your own first? Because I am assuming you must have already completed your, studies. Now it is a revisionary session. So you must be well aware with the calculation part for this category as well. So let me wait for 1 minute in case somebody wants to try and come up with the answer, and then I will discuss the solution. So Ravi has come up with the answer 60,000 plus 70,000 for liability. Okay. So let's see how the calculation will happen in this case. So on the date of the grant, that is 1st of January, what is the value? So either 1,500 shares will be given or the 1,000 shares cash value will be given, right? So what is the fair value of the equity shares on the date of the grant? It is with 102, right? So 102 is the fair value of the shares if the company or the other party chooses the equity alternative, right? So 1,500 into my 102, how much? The amount comes 153,000, right? Cash alternative, 1,000 shares, equivalent fair value. Now, what is the fair value of the cash alternative? 113, right? So 113 is the fair value if the cash is being offered, right? So 113,000 is the fair value of the cash alternative, right? So the delta between the equity alternative and the cash alternative is how much? 40,000, right? So 40,000 is basically the equity option, right? Which is a fixed equity option. Now in year one, what would be my cumulative expense? I will calculate this way. So 1,000 into my 120. 120 is coming from where? Here. At the end, for my liability component, because I need to reinstate my liability at the fair value. So fair value is 120, right? So 120 is taken as the fair value, correct? And 1/2 is the weight, because total vesting period is 2 years. So 1/2, right? So 60,000 is the expense for the cash option in year 1. And for the equity, the amount is 40,000, right? Like we have calculated here, 40,000 is the equity option. So 40,000 into my weight, 1/2. So 20,000, right? So total expenditure comes 60,000 plus 20,000, 80,000 in the year 1, right? Now for year 2, how the calculations will be done? Same fashion. So what is the fair value? 1 lakh, 132. So now the calculation is being done here like 1000 into 132 into 2/2, right? So 1,32,000 is the total expenditure cumulative, and 40,000 into my 1/2. Now here 40,000 into my 2/2, right? So 2/2 is negating itself. So 40,000. So the total expenditure comes how much? 172, right? How much we have already recorded? 80,000. So we will deduct the 80,000 from this, right? The balance is 92,000 recorded in the year 2, right? And the individual amounts would be 20,000 and 72,000, right? So 20,000 is same because the equity option is anyway fixed 40,000 over the 2 years, right? And the cash option, because that is the liability, it is getting reinstated. So 1,32,000 minus 60,000, 72,000, here it is, right? And the total 92,000. So this is how we are going to come up with the calculation for this hybrid arrangement, right? Now the one doubt everybody must be having, that for the grant date, why we are considering the different fair values, right? So we are considering the fair value of 102 for the equity option, but we are considering the fair value of the 113 for the cash option, in spite of the fact ABC Limited shares are the same, right? Whether the company pays in cash or whether the company pays in equity shares, how it matters that the fair value is getting changed, right? Anybody is having that question or didn't thought through? So the answer to this is, when the company says that I will pay the cash, right? It means cash will be fair valued basis on the free, trade fair value of the share, free trade, right? I can sell the share right away. But when the company says that I will give you the shares, but you have a condition that you cannot sell those shares after those are credited in your demat account for next 1 year as well, right? So there is a condition attached that if you choose the equity alternative, and there is a condition that you cannot sell the shares in the market. So that restriction is basically taking away the right of the other party to freely sell those shares as and when received. Yes or no? Yes. Because of this restriction, they have to mandatorily hold the shares for next 1 year, and hence to factor into the fair value. Because of this restriction, the fair value is reduced from 113 to 102, right? So this is done by the fair value expert, right? You don't need to, get into the nitty gritty of how this adjustment is calculated, how this amount delta is calculated. So that is all fair value experts task. The only thing is that we need to understand the concept that fair value means something which is readily available for trade, right? If something is not readily available for trade, then it means there is some restriction, right? And if we factor into the amount of that restriction, then fair value will be reduced or impacted, right? So that's why if the share option is selected, there is a restriction. If the cash option is selected, there is no restriction because cash is paid, right, at the settlement date, and cash can be used for any purposes. But shares, even if received, cannot be sold in the market, and hence, there is a reduced fair value for that. Is that clear to everybody now? Okay. So this is what I wanted to discuss on the 3 accounting with the calculation part. Now let's do some MCQs to test our knowledge on this standard, right? And then we will do some full-fledged practical questions, right? So first question, company B has approved a bonus plan for its employees as per which the amount of the bonus will depend on the share price achieved at the end of the year as follows. If the share price is below rupees 10, the bonus amount is 0. If the share price is between 10 to 12, the bonus amount is 1000. If the share price is 12, then the bonus amount is 1500. Whether the above arrangement is within the scope of Ind AS 102. Option A, yes, it is a equity settled. Option 2, yes, it is a cash settled. Option C, no, it is not a share-based payment transaction at all in first place. And the option D, the company has the accounting policy choice to consider it either under Ind AS 102 or under Ind AS 19 as the company feels. So Samanathan is saying option C. Okay. Others, please respond. Correct. So the answer is correct. So option C, it is not a share-based payment. But the reason is not correct, Samanathan. So reason here is because something is dependent purely on the price performance of the company is not a share-based payment arrangement, right? Because what is happening over here, if the price is rupees 10, nothing will be paid. If the price is 12, then 1000 will be paid. If the price is beyond 12, then 1500 will be paid, right? So this arrangement doesn't meet the definition of the share-based payment, right? The payment is not happening based on the number of shares. It is only happening on the market price movement of the share on the stock exchange, right? So that is a market condition, and that is not the share-based payment arrangement, right? Next, ABC Limited issues its shares to a law firm as the payment for the legal service. Is the transaction within the scope of Ind AS 102? Yes, it is a equity settled. Yes, it is a cash settled. No, it is not a share-based payment transaction. The transaction should be recognized at par value of the share issued. No, it is not a share-based payment transaction. The transaction should be recognized at the fair value. What do you think? Answer option A. Yes, that's correct. Because what is happening over here? I am receiving the legal services from the legal consultant, and I am discharging my obligation for their fees in equity shares, right? Issuing the equity shares of my company, right? So this is a equity settlement, correct? Third, a limited issues stock appreciation rights SARS to its employees. The SARS requires the company to pay the employees an amount equal to the appreciation in the value of 1000 shares of its stock over a period of 2-year period. In this transaction, is this transaction within the scope of Ind AS 102? Yes, it is equity settled. Yes, it is cash settled. No, it is not a share-based payment transaction. And the company has an accounting policy choice to consider this either under Ind AS 102 or under Ind AS 19 as the company feels. So Prashant is saying A, Samanathan is saying B. Prashant has revised its answer from A to C. Okay. So the answer is option B. It is a cash settled. Share appreciation rights. what we spoke about share appreciation rights, that what is the delta in the grant date fair value and the vesting date fair value, that delta will be paid in the cash multiplied by the number of shares, right? So that is called SARS, share appreciation rights. And because it is being settled always in cash, so it can never be equity settled. It will have to be cash settled only. Is that clear? Yes or no?
Yes, sir.
Okay. ABC Limited issues the share options to purchase the company B shares, an unrelated public company, to its employees. Is this transaction within the scope of NDS 102? Yes, it is equity settled. Yes, it is cash settled. No, it is not. And again, the choice is with the company, whether they want to deal, apply 102 or 19, whatever they like. What do you think? Which option is correct?
C.
C. This is not the share-based payment. Why? What is the reason? Because the shares
Unrelated.
unrelated
Unrelated.
company is being offered. It is not of the company, not of the parent, and not of the group company. It is unrelated company, right? Tata is offering shares of the Reliance, right? Like that. ABC Limited enters into a forward contract to buy 1,000 units of commodity. 1,000 units of the commodity at a price equal to 2,000 shares of the ABC. ABC can settle the contract net but does not intend to do so, nor it had the practice of doing so. Is the transaction within the scope of India's 102? Yes, since ABC does not have the practice of settling these contracts net and does not intend to do so. B, yes, all the commodity contracts involving the issue of shares are well covered within the India's 102. No. C, option C, all commodity contracts involving the issue of shares are specifically excluded from the India's 102. Option D, no. India's 102 covers only those commodity contracts for which intention is to settle the net. What is the right answer?
B. Option B.
Option B. Others? So the answer is option A. Since ABC does not have the practice of settling the contract in net and also do not have intention to settle this net, right? So in that case, what is the nature of this contract? So basically, suppose they are buying a future contract to buy the 1,000 kg of, say, coffee, right? Right now, they have just purchased the future contract to buy the coffee beans, right? Now, at the end of the future contract date, what eventually will happen? They will take the delivery of the coffee beans and discharge the obligation by issuing the equity shares. So if they have purchased the coffee beans, right? For example, Starbucks is purchasing the coffee beans, right, through the future contract and discharging the obligation by issuing 2,000 shares. So what do you think? This is a equity settled transaction, yes or no? Yes. Just because of the fact, instead of directly buying the coffee beans, they have purchased the future contract to take the delivery after the 2 months from the contract date doesn't change the color of the transaction unless and until company is not intending to take the delivery and settle the contract on a net by just gaining the appreciation in the coffee prices, right? So in that case, it would be treated as a derivative and accounted for under Ind AS 109 through the P&L, FVTPL, fair value through P&L accounting for the derivative. But in this case, this is considered as a raw material purchase for the Starbucks. So it will be a purchase transaction from the party, right? By issuing equity shares. So equity settled, correct? Clear? Next, ABC Limited has granted a right to its employees to receive a cash payment equal to the excess of the share price over rupees 20 multiplied by 2,000. For example, if the share price is rupees 30 at the end of the year 3, the employee will receive 20,000. This is subject to the employee continuing with the firm for the 3 years. Whether this arrangement is covered within the Ind AS 102 share-based payment arrangement? Answer: A, cash settled. B, equity settled. C, compound. No, it is not a share-based payment transaction. Yes, what's the answer? So Samaynathan is saying option A. Okay, others? Correct. So this is a cash settled. How come this is a cash settled? Because what the arrangement says? Arrangement says that price, which is X, over rupees 20, right? 20 is the base price, into May 2000 units, right? So this units means the number of SARs, right? So standard is not specifically calling out SAR word, but they are saying 2000, right? So 2000 is the number of SARs, X is the future price, and 20 is the grant date price, right? GDP or the base price. So whatever is the fluctuation in the value of this SARs into my number of SARs will be paid in the cash. So that's what the SAR is. Correct? Is that clear? Okay. So that was all on the MCQs. Let's have a quick break of how many minutes? 3 plus 5, 8 minutes. Okay. We will resume at 8:45 and start some practical questions on this standard, right? Ashokji, break started. So this question we have already just discussed before the break, right? The same hybrid question. So let's start with the question number 2 only, because this we have already covered. Okay. Tata Industries issued share-based option to one of its key managerial person, which can be exercised either in cash or in equity, and it has the following features, right? So again, from the first line itself, we are getting to know one important thing, that this is the hybrid contract, right? Neither this is the equity settled nor it is the cash settled, right? Because there is the option available, whether it can be equity settled or it can be cash settled, basis on the option chosen by the employee, right? The KMP. Option 1, number of cash settled shares will be how much? 74,000 shares. Service condition 3 years. Option 2, number of equity settled shares of face value 100 each, 90,000, right? Service condition 3 years and restriction to sell for next 2 years, right? Once the shares are received to the employee, they cannot sell those shares for next 2 years, right? So this is the option 2 arrangement. So because there is an option either to receive cash or to receive shares, right? So this is a hybrid arrangement, right? Now the fair values for all these options are given. So equity price with the restriction for sale of 2 years is 115, and fair value of the grant date of the normal shares without any such restriction is at the end of year 0, year 1 and year 2 is 138, 140 and 147, right? So more or less the same type of question which we have just discussed before. Now what we are asked is to pass the journal entries in this case, right? So first of all, we need to come up with the amount of the expense for the year 1, year 2 and year 3, right? The liability component for the year 1, year 2 and year 3. And once we are done with the calculation, we will pass on these journal entries. So because we have just did a similar question before, right? Would you like to try the calculation part at least on your own and come up with the amount of expense and the liability for the year 1, year 2, year 3, and then I will discuss the journal entries, right? Is that fair? So I'm just waiting for a couple of minutes to see your responses in the chat box, right? So practice is the key, although it applies to all standards, but for this standard specifically, because if we know the concept, we learn the theory, but in the examination, by some silly mistake, our amount of expense and liability, arrived wrong, then we will lose almost the full marks, right? Yes. Okay. Any luck with the answer? So first of all, you need to compute the fair value of the equity option and the fair value of the cash option. Then you need to arrive at delta between the cash option and the fair value option or equity option. And then that delta would be regarded as the equity option. Remaining is the liability component. Then you need to allocate the equity component and the liability component over the vesting period, right? By applying the weights 1/2, 2/2, 3/3, and come up with the answer of the expense, right? So I just revise the steps you need to perform. Okay, so might be you can just stay with your answers and then match your answers with the solution we are going to discuss. Okay, so let's do the discussion of the solution. So fair value of the share with the restrictive clause is given in the question 115, right? And for what purpose we will use? For the equity option fair value, right? So if the company or the KMP chooses equity shares to be received, then 90,000 is the number of shares which will be, offered to them. And the fair value is given in the question 115. So the total fair value of the equity option comes 103,50,000, right? So this is the fair value of the equity option. Then the fair value of the cash option would be 135 given in the question, right? Number of shares for the cash option is 74,000 only. So 74,000 into my 135. So 99 lakhs 90,000 would be the fair value of the cash option, right? Now we will derive the equity component, right? So what is the method? A minus B, that is 3,60,000, the delta between the equity component and the cash option, right? So 3,60,000 is the fixed equity component in this hybrid arrangement. Now, we just need to come up with the calculation of the expense amount, right? So, fair value of the cash option is how much? 90,000, right? And fair value of the equity option is how much? 3,60,000, right? Which eventually gives us the total fair value of the equity option, right? Now, employee benefit expense, certainly we will be debiting, right? The P&L account will be debited for the expense, be it the equity settled or the cash settled. Nothing goes to OCI, always everything goes to the P&L in the form of expenditure, right? And expenditure is for the employees. So employee benefit expense, right? Maybe you can add one more word, share-based payment, right? Share-based employee benefit expense, just for easy identification, right? So how this amount is calculated? So this amount is calculated for two components. One, the share-based payment reserve equity option and the share-based payment liability, the cash option. So 3,60,000 as we have computed above, into my 1/3, right? And 138 into my 74,000 into my 1/3, right? So these are the amounts for the year one, right? And total of these will be the total expenditure for the year one, and the entry would be share-based employee benefit expense to equity reserve share-based and liability share-based account, right? Are we on the same page until this entry? Yes, no? Please try to be responsive. No response? Are you guys there? I'm just asking.
Yes,
Okay. Then for year two, again, we need to pass the same entry, right? Employee benefit expense to share-based payment equity reserve and the share-based payment liability. Now, again, the calculation will be 3,60,000 is the amount fixed, right? So 3,60,000 into my 2/3 minus the previous amount. But because this amount is fixed, right? So anyway, even if we apply the weights 1/3, 2/3, 3/3, it will fetch the same answer. So for the sake of simplicity, we can simply divide by 3, right? So 1,20,000, because this amount is fixed throughout the life, right? Now for the liability, we need to do the calculation again. So again, the revised fair value at the end of year 1 is 140. Number of shares is fixed 74,000 into my weight 2/3 minus the amount which we have already recorded in year 1, right? So it will fetch us the expense for the year 2, right? And the total of this will be the total employee benefit expense, right? Is that clear?
Yes, sir.
Similarly, in the third year, again, the same entry, employee benefit expense account debit, right? To share-based payment equity. Again, 3,60,000 divided by 3 because this amount is constant throughout the life. So 1,20,000. And again, the 147 is the year-end fair value given in the question. 74,000 is the number of shares. Weight is 3/3 minus year 1 expenditure minus year 2 expenditure, which we have already recognized. So the delta would be the third year. And the total of this would be the total employee benefit expense for the year 3, right? So this is how we are going to record the journal entries for each of the years for this hybrid arrangement, right? I hope the calculation part is ultra clear to everybody for these hybrid arrangements. Now we are done with the 2 numericals on this. Right? Now, lastly, if the party chooses the cash alternative, then what would be the accounting? And if the party chooses the equity alternative, then what would be the accounting entry for the settlement, right? So on the date of the settlement, party comes and asks for the cash. Then I will do share-based payment liability account debit into 147 into 74 because 147 is the fair value on that very date, right? To bank. So this is the cash I need to discharge now, right? So this entry I will pass. So I will debit the liability amount and credit the bank account, right? If the other party comes and asks for the cash, right? So being settlement made in the cash. And the another entry which I will pass upon is the share-based payment equity reserve account to general reserve or the retained earnings for the amount which we have accumulated over the 3-year period in our reserve account related to the equity. Because the settlement is happening in cash, so this 3,60,000 will straight away be transferred to the retained earnings, right? Upon the settlement. Is that clear? Any questions on this? Any doubts on the settlement entry? Yes, no? Okay. So in the absence of any doubt, I can safely assume it is understood. Now, instead of cash settlement, if the other party comes and asks for the equity shares, right? And now the settlement is happening in equity, then what would be the journal entry? In that case, what I will say, share-based payment liability account debit, because anyway, I have to, clear this liability from my books of accounts. Now, because I'm not discharging or paying cash, but I'm issuing the equity shares, equity share capital account will be at the face value, right? Face value, right? Face value is how much? 100 rupees given in the question. So 90,000 shares into my 100. So 90 lakh would be the amount by which the share capital account will be increased by virtue of issuance of equity shares, right? And the remaining amount, right, will go to the securities premium, right? So if the shares fair value is say 150, then out of this 100 rupees is the face value and the security premium is the 50, right? So 50 will be credited in the security premium and 100 always comes to the main equity share capital issuance account, right? So this is how this 90 lakhs is fixed and the delta goes to the security premium, right? Is that clear? So the total liability I had on my books is how much? 1 crore 8,78,000, right? Which I need to clear by the settlement. So this liability I have already accumulated over the period of 3 years, right? So this liability now needs to be cleared. So liability will be debited, equity share capital account at the face value will be credited, and anything else will go to the security premium. Right?
Yes, sir.
Now, again, last item. Because we also have accumulated this 3,60,000 reserve over the period. So this we also need to clear because the settlement is done now. So this reserve is no more required to be continued in our books, right? So same entry, share-based payment reserve, equity 3,60,000 to the securities premium, 3,60,000. Now the difference between using the account of retained earnings and security premium is if we are settling the transaction in cash, then it will go to the retained earnings, right? But if the transaction is happening or settling in the equity shares, then it will be credited to the securities premium because it is related to the issuance of the equity shares, right? So this is how the accounting entry has to be made for the both the options. Any questions, doubts, queries? No?
No, sir.
Perfect. So let's do question number 3. An entity which follows the financial year as per the calendar year grants 1,000 share appreciation rights. Share appreciation rights, right? 1,000 share appreciation rights. So as and when you read the word share appreciation rights, one thing is very clear that this is a cash settled item, right? SARs can never be equity settled. SARs are always cash settled, right? Each of its 40 management employees. So 40 is the number of employees on 1st of January and the year end is December year end, right? SARs provide the employee with the right to receive on the date when the rights are exercised a cash equal to the appreciation in the entity's share price from the grant date. So what is the fair value on the grant date? From that date, whatever would be the fair value on the exercise date, the delta would be provided in cash or paid in cash to these 40 employees, whoever completes the vesting period, right? All the rights vest on 31st December 2006 and they can be exercised during 2007 or 2008. So 2 year is the vesting period or exercise period offered by the company. Management estimates that at the grant date, the fair value of each SAR is rupees 11. The estimate overall 10% of the employees will leave during the 2 year period. So 2 year period means total period is how much? Vesting period, 2 years. The fair value of the SARs at the end of year end for each of the years below is given 2005, 6, 7, and 8. So these are the fair value of these SARs, right? 10% of the employees left before the end of the 2006 on 31st December 2007 when the intrinsic value of the SAR was 10. 6 employees exercised their options and the remaining 30 employees exercised their options at the end of 2008. So what's the additional facts are says that 10% employees left. So 40 minus 4, 4 left. How much remaining? 36. So out of 36, 6 exercised in 2007 and 30 exercised in 2008 for their cash settlement, right? Because these are SARs. How much expense and liability to be recognized at the end of each year? Past journal entries. So do you want to perform the calculations first on your own? What would be the expense for the year 1? What would be the expense for the year 2? And if there are any expense in the year 3 and 4 as well. So just try once on your own. Anyway, we'll see the solution.
2,16,000 for the first year.
Okay. For the second year.
$72,000. $72,000.
So just reconcile your calculations with the solution once. Yes. So 36 is the number of employees. 1,000 is the number of shares. 12 is the fair value. And weight is 1/2. Right? Correct? So 2,16,000 would be the amount of the liability and the expense for the year 1. For year 2, 36 is the number of employees. 1,000 is the number of options. And 8 is the fair value. And weight is 2/2. Right? So 2,88,000 is the total cumulative amount minus 2,16,000. So 72,000 would be the expense, right? Is that clear? Vesting period calculation. Now, because the settlement period or the exercise period is 2 years, right? 2007 as well as 2008. Now, few of the employees have exercised their right in 2007 for the settlement, and few of the employees have exercised their right for the settlement in 2008 as well, right? So in that case, we have to calculate how much the settlement is happening in these years, and accordingly, if there is any expenditure which we need to record, right, because of this settlement. Now, entity comprises an increase of the liability of 102,000 and cash paid to those exercising their SARs of 60,000. So 6 employees have exercised their right in 2007. 1,000 is the number of options and 10 is the fair value on the date when they have exercised the right, right? And we know for certainty, whenever we are accounting for any cash settled arrangement, we always do the fair value, right? On the each reporting date as well as on the date of the settlement. Now, the date of the settlement is coinciding with the reporting date, for which the fair value is given in the question rupees 10. So 6 into 1,000 into 10. So 60,000 is the payment finally the company is making to these 6 employees who have exercised their rights in 2007, correct? So 60,000 is the payment. Now, the total liability also we need to reinstate, right? So how that reinstatement will happen? 30 is the number of employees who haven't yet exercised, right? 1,000 is the employees and 12 rupees is the fair value given in the question. So all these fair values are given in the question, right? Here. So 2008 fair value is also 12, right? Now, this amount comes 3,60,000, right? And our opening liability is how much? 3,90,000. Here it is, right? So 30,000 would be the delta or the additional expense which we will record, right, for this reinstatement of the liability. Is that correct? Because for 2007, the liability had been reinstated for how many number of employees? 30 only, because 6 employees have already got settled. So at the end of the 2007, after settling the 6 employees, the liability is for how many? 30 employees into 1,000 into 13. So this comes to 3,90,000, right? And earlier liability was how much? 2,88,000. So 390 minus 288 plus 60, which we have already made the payment to these 6 employees. So the delta comes 1,62,000, which is the expense for the year 7 on account of reinstatement of liability for the 30 employees and discharging the obligation for the 6 employees. Is that clear? Are we on the same page for this? And thereafter in 2008, we will recompute for these 30 employees, 30 into 1,000 into 12, right? 12 is given, 360, 360 minus 390. So 30,000 is the gain on reinstatement. So this gain will also be recorded in the P&L. And because in 2008, these 30 employees are also discharged in cash, so the closing liability will eventually be 0. Right? Is the calculation part clear so that I can proceed on the journal entries?
So this 162, please explain once.
This
2000,
160.
2007.
Yeah. So what was my opening liability? 288? Yes?
Yes, sir.
How much is the payment I have made for the 6 employees?
60,000.
So 60,000 is the payment. So what is the balance of my closing liability for after discharging this 60,000? 2 lakh 28, right? 2,28,000, correct? Because 60,000 I have already paid, right? Now for the remaining 30 employees, what would be the liability? 30 into May. 1,000 into May. 13. 13 is the fair value given in the question at the end of the year 2007, correct?
Yes, sir.
Now, since for the 30 employees only, I now have to have liability in my books because for 6 I have already discharged, correct? So that liability is now how much? 3,90,000. Right? So what is the delta between the two?
Yes.
Clear? Is that clear?
Yes, sir.
Perfect. Okay. Now the same entries which we have been passing since ages. Employee benefit expense account debit to share-based payment liability account. Why liability? Why not equity? Because in the hybrid, we do not know whether ultimate settlement will happen by issuing equity shares or by paying cash. Hence, the accounting entries will be formulated basis on assumption that this will be a liability, right? So we will always assume SARS as a liability only, right? So share-based payment liability, 2,16,000, 2,16,000, right? Employee benefit expense to share-based payment liability, 72,000, 72,000. So this is the year 1 entry. This is the year 2 entry, right? Expense being recorded. And the closing liability at the year end is 216 plus 72, right? So 628 or 78. So 288 would be the liability at the end of the year 2 in my books after passing this entry, right? In year 3, what is happening? So I will reinstate the liability as well as make the settlement. So the additional liability which I have computed is 1,60,000. 62,000. So expense will be debited again. The liability will be credited again by this amount, which we have already discussed. And the 60,000 if is discharged. So share-based payment liability account will be debited now by the bank or cash, as the case may be, right? So 60,000. So this is for the settlement of 6 employees. Good to go until now? Any questions? Okay. Then in year 3, finally, again, share-based payment liability will be debited to employee benefit expense by the opposite entry, because this 30,000 is gain now, because the fair value has fallen from the previous year fair value, right? So that's the gain. So the gain will be recorded as by reversal of the employee benefit expense in this year and reversal of the liability. So liability is debited in this case and the expense is credited in this case, right? So 30,000 is recorded like this. And finally, the liability is how much? 3,60,000 at the end of the year 4. And because the remaining 30 employees have also exercised for the cash, so we will credit the cash and settle this obligation completely. Clear? Any questions on this? So the only key is to do the right calculations. Once you are done with the calculation part, there is no complexity in passing any journal entries, right? So journal entries, anyway, we know by heart what needs to be debited, what needs to be credited, right? The only thing is the amount. So if we are perfect in our calculations, solution will be fine and we will receive full marks. Any questions if you want to ask? Else I will proceed with the question number 4. Okay. Fine. New Age Technology Limited has entered into the following share-based payment arrangement. On 1st of April 2001, New Age Technology Limited decided to grant the share options to its employees. The scheme was approved by the employees on 30th June 2001. The New Age Technology determined the fair value of the share options to be the fair value of the equity shares on 1st of April 2001, right? On 1st of April 2001, New Age Technology entered into a contract to purchase an IT equipment from the Bombay Software Service and agreed that the contract will be settled by issuing equity shares of the New Age Technology Limited. The New Age Technology Limited received the IT equipment on 30th July 2001 and the share-based payment transaction was measured based on the fair value of the equity instrument on the 1st of April 2001. Third, on 1st of April 2001, the New Age Limited decided to grant the share options to its employees. The scheme was approved by the employees on 30th June 2001. The issue of the share options was, however, subject to same being approved by the shareholders in the annual general meeting. The scheme was approved in the general meeting held on 30th September 2001. The fair value of the equity instruments for measuring the share-based payment transaction was taken on 30th September 2001. Identify the grant date and the measurement date in all the above 3 scenarios of the share-based payment transactions entered into by the company and support your answer with appropriate rationale, right? So basically you need to tell in all the 3 above cases what is the grant date and what is the measurement date. So which date you will assume as the grant date and which date you will consider for measuring the fair value. That's the ask. So what is in the first case? At least no calculations. You just simply need to tell which date you will consider as the grant date and which date you will consider as the measurement date.
30th June.
Okay. Others? Okay, so maybe you can decide upon for all the three options and we will discuss in one go, right? At least you decide in your heads which date you like to be the grant date and the measurement date. So how we need to construct our answer, that is also important in these theory types questions, right? So we can't simply, mention the dates in the examination. We have to give our rationale as well, right? So Ind AS 102 defines the grant date and the measurement date as follows. So grant date, the date at which the entity and the another party, that is including the employee, third party including the employee, agree to a share-based payment arrangement, being when the entity and the counterparty have a shared understanding of the terms and conditions of the arrangement. At the grant date, the entity confers on the counterparty the right to cash or other assets or instruments of the entity, provided the specified vesting conditions, if any, are met. If that agreement is subject to the approval process, for example, by the shareholders, the grant date will be the date when the approval is obtained, right? So this is the definition given by the standard, right? And the measurement date. What is the measurement date? The date which the fair value of the equity instruments granted is measured for the purpose of this Ind AS, right? So measurement date would be the date on which the measurement will take place. That is the fair value of the equity instruments granted. For transactions with employees and others providing similar services, the measurement date is the grant date. So for employees, measurement date will always be the grant date. And for transactions with the parties other than the employees, the measurement date is the date when the entity obtains or receives the goods or the counterparty renders the services, right? Like I took the example of Hindustan Media newspaper advertisement print, right? So when the advertisement is printed, then only it will be considered as the other party has rendered the service. Applying the above definition in the given scenarios, following would be the conclusion based on the assumptions that the approvals have been made, have been received prospectively. So in the case 1, grant date would be the 30th June and measurement date would also be the 30th June. And why it is so? The date on which the scheme was approved by the employees, right? Because grant date is the date when the employees and the entity have a shared understanding, right? And for the measurement date is always the grant date in case of employees. Hence, both the dates are 30th June. Is that clear? Now, in the second scenario, 1st April is considered as the grant date and 30th July is considered as the measurement date. Why? Because the date when the entity and the counterparty entered into a contract and agreed upon settlement by the equity instruments. So this contract has been entered on 1st of April. So shared understanding was established on when? 1st of April. But the goods are received from the counterparty on which date? 30th July. So measurement will happen on 30th July, because in the case of other party other than the employee, measurement happens on the date when the goods are received or the services are rendered, right? Is that clear? Any questions?
Yes.
Okay. And in third scenario, grant date as well as the measurement date would be the 30th September. Why so? Because by virtue of the definition of the grant date would be the date by which there is a shared understanding between the employees and the other party, as the case may be, and the entity, subject to the approval by the shareholders or other parties if necessary. Because in the third scenario, approval of the shareholders was the precondition and shareholders AGM was conducted on 30th of September only, and hence approval was obtained on 30th of September only. So the grant date would be the 30th of September, right? Because this arrangement is with the employees. So for employees, measurement date will always coincide with the grant date. So 30th September would be the measurement date as well. In case this arrangement is not with employees but with some other party, then we will see on which date the other party is delivering the goods or services. Then that date would be considered as the measurement date, but the grant date would continue to be 30th September in that case even. Is that clear? Yes? Yes, no?
Yes, sir.
Okay, now the real challenging question is coming, right? And if we understood this question completely, then we are done, at least for this standard, right? So I need your 100% attention on this question, because this is not going to be an easy question. If it comes in the examination, it will make, the life miserable, right? Following particulars in respect of the stock options granted by the company are available. Number of employees covered, 400. So 400 is the number of employees. Face value of the share, that is the nominal value or face value by whatever name you call it, 100 rupees. Number of options per employee is 60. So each employee, whoever meets the vesting period conditions, will get 60 options. And the exercise price for these options is 125, right? So these are the facts until now. Shares offered were put in the three groups. Group 1 was for 20% of the shares offered with a vesting period of how much? 1 year. Group 2, 40% of the shares offered with a vesting period of 2 years. And Group 3, for the 40% of the share offered with a vesting period of 3 years. Fair value of the option per share on the grant date was rupees 10 for Group 1, 12.5 for Group 2, and 14 for Group 3. Right? So the whole employee stock option plan is divided into the three groups. Group 1, Group 2, Group 3. For the Group 1, vesting period is 1 year. For Group 2, vesting period is 2 years. For Group 3, vesting period is 3 years. Right? And in Group 1, 20% of the total shares will be offered. In Group 2, 40% of the total shares will be offered. And in Group 3, 40%. Remaining 40% of the shares will be offered. And total number of shares is 60 for each employee, and total number of employees are 400. Right? Now, position on the first year. So number of employees left during the 1 year is 40. Number of employees left in the year 2 is 35. Number of employees left in the year 3 is 28. So this is the actual lever data for the 3 years. Estimate of the employees to be left in year 2 is 36. In year 1, this is the estimate, right? So in year 1, 40 already left, 40 already left, 36 is expected to be left in second year, and 34 is expected to be left in year 3 as well. This is the assumption of the management on year 1. For year 2, the position is 35 further left, 30 is expected to be left in year 3. And for year 3, 28 actually left, right? And employees which are finally there, 295, exercising the options, correct? For year 1, for Group 1, for which the vesting period is 1 year, 350 employees are exercising the option. For year 2, Group 2, 319 employees are exercising the option. And for year 3, for Group 3, 295 employees are finally exercising the option. Options not exercised immediately on vesting are forfeited or lapsed. Compute the expense to recognize in each of the year in the books of the company for the 3 groups. Group 1 expenditure, year 1, year 2, year 3, right? Group 2 expenditure, group 3 expenditure. Can you come up with these amounts? And then the total expenditure for the year 1, year 2, and year 3. Can you come up with the answer by making the calculations? I'm giving you few minutes just to think through how you will proceed on this question if this type of question comes in your examination. Certainly, I will discuss the solution and the nitty-gritties of the solution as well. But at first, I want you to, just think through what you are able to gather from this question in terms of relevant facts and how you will proceed with the calculation. Okay, prima facie, what do you think? What we are getting from this question? Are we getting 3 separate plans in this question, or this is a one plan only? So let me give you some clues and hints. So because the whole plan is divided into 3 groups, group 1, group 2, group 3, and each group has a different vesting period. Group 1 has 1 year, group 2 has 2 years, and group 3 has 3 years. And we know whatever we have learned so far in this standard is that we have to accrue the expenditure over the vesting period, right? So can I say that in this question, we are actually getting a flavor of 3 questions into one question, right? So why 3 questions or why 3 plans? Group 1 in itself is a plan. Group 2 in itself is a plan. Group 3 in itself is a plan. For group 1, you need to come up with the calculation assuming the vesting period is 1 year. For group 2, you need to come up with the calculation of the expenditure and the liability assuming the vesting period is 2 years. And for group 3, it is 3 years. So basically what the complexity in this question is added by having 3 plans put together with 3 different vesting periods, right? So how you need to proceed on these type of graded options, generally we refer this structure of ESOP as a graded option, where the vesting is happening in a graded manner. Graded manner means few of the options are being vested in year 1, few are vesting in year 2, and few are vesting in year 3, right? So in case of graded vesting, we generally compute the expenditure for each grade, assuming this is a altogether separate plan itself, right? So for each of these 3 plans, you need to calculate the expenditure the way we have been doing it until now, whenever we were getting only one plan in our question. So that's the hint I have given to you. Now maybe you can try your hands to come up with the answer for at least year 1. What would be the total expenditure for the year 1 at least? Yes, any luck? So group 1 year 1 expense Samanathan is saying 43,200. Group 1 year 2 and 3 to be calculated. Then we will have the full expense for the year 1 group 1. Okay. But you are saying 43,200 is the year 1 group 1 expense. Okay. So I hope everybody is at least trying and not waiting for the solution discussion, because unless and until you try, nothing will work out. Okay. So let's proceed and see how the calculation will happen. So total number of options per employee is how much? 60 options for each employee. 20% are being vested as part of the group 1 in the year 1. 40% are being vested as part of group 2 in year 2 and year 3, because 2 years is the period for the group 2. And for group 3, the period is 3 years. So 40% are vesting in 3 years period, right? So 60 into 20%, 12 options, right? Vesting period 1 year. 60 into 40%, 24 options, vesting period 2 years. 60 into 40%, 24 options, vesting period is 3 years. Is that correct? Right. So 12 options are vesting over a period of 1 year. 24 options are vesting over a period of 2 years. 24 options are vesting over a period of 3 years, right? Calculation of expense for all the years, right? Now, because in group 1, we have only 1 year, so 1 column. In group 2, we have 2 years, so 2 columns. And in group 3, we have 3 years vesting period, so 3 columns, right? So this is how we will structure our solution for the ease of understanding, right? And saving our time in the examination, right? As well, if we come up with the right table construction, it will be much easier to save time in our examination, right? Now, employees at the year end, 400 is the total number of employees. 10% is given in the question are expected to leave, right? So 400 minus 40. So 36 would be the number of employees opening on the year 1. On for group 2 as well, 400 minus 40 for the year 1, right? And for year 2, it would be 360 minus 35, because 35 is further given in the question that will be expected to leave in the upcoming year, right? And for the group 3, it would be in the year 1, 400 minus 40 only. In the year 2, 360 minus 35. And in year 3, it would be 325 minus 28. So all these numbers are given in the question, right? Are we on the same page? Until
Yes.
the calculation of
Yes.
number of employees? Yes.
Yes.
So for year 1, it would be 360 employees in the group 1. For group 2, again for the year 1, it would be 360 and 325 for the year 2. And for group 3, 360 for year 1, 325 for year 2, and 297 for the year 3. So these are the number of employees, right? Now, furthermore, the question says there are few more employees expected to leave in the future apart from those which have already left, right? So expected to leave in the year 1, furthermore, not applicable because there is nothing given in the question. Expected to leave in the year 2 for the group 2 plan is 36. For the year 2, there wouldn't be anything. And for group 3, in the year 1, there would be 36 plus 34, total 70. And in year 2, it would be 30. And in year 3, nothing, right? Not applicable. So this is the expected number of employees to be leaving over and above who are already left, right? So this information is also given in the question. We have just populated all this information in this chart or in this table. Now we will derive the number of employees eligible for the options. So for the group 1, it would be 360. For the group 2, it would be 324, 325, 290, 295, and 297, right? So by presenting this, at least we are done with the showcasing how we have computed our number of employees who are finally eligible for these, 3 groups and all the years, right? Now, using this number of employee, I will multiply the number of options for each of the group. So 12 is the number of option in the group 1, 24 is the number of option in the group 2, and 24 is the number of option or shares in the group 3 as well, right? So this I will multiply. Now the total number of shares under these groups will be 4320, 7776, 7800, 6960, and so on, right? So this is all the game of multiplication, right? Which we are already master with. Now the fair value is also given in the option for all these years. So 10, 12.5, 12.5, 14, 14, and 14, right? So this is the information given in the question. We have just populated it here. And now we will come up with the total value of the total options, right? So this into my this, and so on, right? So this is the total number of options value, fair value, basically the award value, right? Now the cumulative charge, for the purpose of calculation of accumulative charge, we have to apply the weights on this, right? So weight is vesting over 1 year. What is the weight? 1 by 1? Yes or no? So 43,200 would be the total amount for the group 1. For group 2, the period is 2 years, so weight is 1 by 2 and 2 by 2, right? So this would be the 48,600 and 97,500. For the group 3, the period is 1 by 3, 2 by 3, and 3 by 3. So these are the corresponding amounts multiplied by this, right? Now, since we reached this stage, now we simply need to deduct. So 43 minus 43. So to be recognized in last year 0, right? So 43,000 is the total amount which we will recognize under the group 1 in the year 1 itself. Because vesting period is 1 year, so there is nothing recognized in the previous year. There is nothing to be recognized in the upcoming years. So the all amount will be recognized in the year 1 itself. Now, for group 2, anything recognized in the previous year? No, 0. So 48,600 would be the amount. And this 48,600 is recognized in the previous year for year 2. So remaining balance is 48,900. That is 97 minus 48,600. So 48,900. Correct? And similarly, for year 1, it is also 0. For year 2, this is the amount. And for year 2, for year 3, so the total amount is how much? This plus this, right? And the balance is this, right? So this is the calculation mechanics we have already learned. Once these calculations are done correctly, then we are left with the task to tell what is the total expenditure for the year 1, total expenditure for the year 2, and total expenditure for the year 3. When I say total expenditure means total of the group 1, group 2, group 3 for each of the years. Is that correct? So if I need to come up with that, then how I will calculate? So for the year 1, group 1 43,200, group 2 48,600, and group 3 32,480. For year 2, there is nothing in group 1 because everything is recognized in group 1 year 1 itself. So 48,900 plus 33, and in group 3 there is third year expense as well. So this would be giving me the total amount of expenditure for these 3 years, right? And once I get these 3 amounts, I will simply be able to pass the journal entry. Journal entry anyway I have already, ready by heart. So what is the journal entry? Employee benefit expense account debit to share-based payment equity account, right? So In year 1, amount will be this. In year 2, amount will be this. And in year 3, amount will be this. Right? Any questions, doubts here? Did you understood the calculation part? How we are going to calculate and also present these calculations for easy, understanding of the examiner as well? Because if we go and create multiple number of working notes, right, we will spend a lot of time. So the smarter way is to construct a table and then simply plot the facts, do the multiplication and come up with the final amounts. It will save time as well. It looks easy to understand to the examiner as well. But otherwise, if you are not good with constructing the table, the way you are comfortable with, maybe you can create these calculations in separate working notes and refer those working notes. So either way you can perform. There is no hard and fast rule that we have to do in the tabular format only, but this is easier to understand. So that's why I recommend. Any doubts on the calculations? No? Now, the standard says, question says, what is the ask in the question? So the ask is, compute expense to recognize in each year and show important accounts in the books. So question is not asking the journal entries, but asking you to present the ledger accounts for all the important accounts. So what are the important accounts? Of course, there are only two. Number 1, the employee benefit expense account. Number 2, the share-based payment reserve account, right? So we will present both the accounts in this format, right? So for year 1, the total expenditure we have recorded, right? So share-based payment reserve account is credited and employee benefit expense account is debited. So that's why it is reflecting as employee benefit expense account to share-based payment account 1,24,280 by PNL account 1,24,280. The amount is charged to the PNL. In year 2, again the same entry. For the year 2 expense, again the same entry, passing on or charging the PNL. Again the balance is nullified, no carry forward, no brought forward. In year 3, again same entry with the year 3 expense amount, same charge to the PNL and no carry forward, no brought forward. Account is super simple to present, right? Employee benefit expense account, right? This is how we are going to present employee benefit expense account. Is that clear? Yes, no, please. Okay. Now, we will present the share-based payment reserve account. Now, in the share-based payment reserve account, we will first of all credit the employee benefit expense account because this is the ideal way to present this entry here. Both the legs are accounted for now. Now, because my group 1 is getting vested within the year 1 and getting settled as well, because once the vested, it is settling as well. So I will make the payment as well to 350 employees at the fair value into the number of options. So 5,25,000 would be the amount which I will be settling for my group 1 employees, right? So 350 is the number of employees. I just simply take it from the table which we have just drafted in our solution itself. 12 is the fair value anyway given in the question, right? And 125 is the total number fair value and 12 is the number option for the group 1, right? So 350 number of employees, 12 is the number of options and 125 is the fair value given in the question, right? So 5,25,000 I will pay by bank and this expense I have already recorded in the year 1 as a part of the total expenditure for all the 3 groups, right? But the settlement is happening only for the group 1, right? And the entry would be to share capital to securities premium because I am issuing the shares, right? So 350 employees into my 12 options into my 100. The nominal value 4,20,000 and securities premium 350 employees 12 options into my 35 is the security premium balancing amount 1,47,000. So this is the issuance of equity shares and this is the exercise price. Basically, I by mistake said it fair value. The exercise price which we are collecting from the employee by virtue of the settlement, right? So 125 is the exercise price given in the question. Here it is. Right? This is the exercise price that is the employee needs to pay to the company, right? 125. Okay. So in our share-based payment reserve account, first of all, the employee benefit expense will be recorded, right? Then whatever I'm collecting from the employee as an exercise price, that will be recorded. The number of shares I am issuing at the face value will be recorded in the share capital account and remaining in the securities premium account, right? And because there is a settlement completed for the group 1, right? So 10 employees, right? Earlier it was planned for 360, but eventually settlement is happening for 350. So 10 is the number of employees for whom the options are forfeited. So 10 employees, 12 options and 10 rupees, right? So 1200 would be transferred to the retained earnings as well because these options are getting cancelled. Correct? And after all these, whatever is the balance, that will be carried forward for the next year, year 2. Similarly, for year 2, we will do the settlement for the group 2. For group 2, the settlement number of employees is how much? 319. They are exercising the option, right? 24 is the number of options and 125 is the exercise price. So this amount we will collect. This is the amount brought forward from year 1 and this is the amount which we have recorded as the expense in the year 2 basis our calculation. Similarly, we will issue the equity shares for 319 employees at 24 options at 100 face value, right? And because out of the 325 employees eligible, only 319 exercise. So remaining, how many employees? 6 employees. Option is cancelled or lapsed. So 6 employees, 24 options into my 12.5 is the fair value given in the question for the group 2 year 2 plan, right? So this amount will be transferred to the retained earnings, right? And security premium 319 into my 24 options into my 37.5. So this would be the amount for the securities premium and balancing figure would be carried forward as the closing balance, right? The total tallies. Clear? Okay, so securities premium calculation. So how this is arrived, right? So what is the total fair value in my plan? So what is the total fair value given in the question, right? Fair value per option is how much? 12 rupees 50 paisa for the group 2 and 14 rupees for the group 3, right? And what is the nominal value given in the question above? 100 rupees, right? 100 rupees is the nominal value which I am receiving, right? 125 is the exercise price. Now, this is the fair value of the option, correct? And just a minute, let me find the relevant line. in my table. Where is that information? So how did we arrive at the security premium calculation is 319 is the total number of employees who are finally receiving the shares, and 24 is the number of options which they are receiving, and 37.5 is the delta price which we have arrived by deducting the fair value. So fair value is 12.5, right? 12.5, and the total value is how much? 150 minus 100 is the face value, right? Minus 12.5 is the fair value of the option, is equal to 37.5. This is how this 37.5 is arrived. Similarly, for year 3, when I'm going to settle the group 3, I will arrive at with this carry forward balance from the year 2, third year expense, and in year 3, because for group 3, 295 employees are exercising their options, 24 is the options, and 125 is the fair value, right? So 125 minus 100, right? Minus the fair value of the option. How much it is in the case of this group 3? It is what I remember is 11, I guess, right? So that's why we will receive the 295 employees into my 24 into my 100 share value, fair value option for the share capital account, which we will credit, and the securities premium for the same 295 employees into my 24 options into my 39 rupees for the securities premium, the remaining balance 2,76,000, and 14 rupees into my 24 options into my 2 employees, because 297 was the expected employees, but 295 is the actual employee which finally exercising. So 2 employees have got their rights forfeited, right? So 2 into my 24 into my 14, right? So 672 would be the amount which is being transferred to retained earnings in the year 3 for the group 3 settlement. Now, exercise price is how much? 125 in all the 3 groups, right? And value of service received per share is fair value 10, 12.5, and 14. Correct? So the total consideration, notional consideration is 135, 137, 139 minus 100 the face value and the securities premium value for year 1, year 2, and year 3, right? Is it clear? Because we will compare the total amount which we are receiving from the employee and the face value plus the fair value of the initial option which we had granted to the employee, right? And by comparing these, we will arrive at the delta, right, between the issuance price, the notional issuance price, and the face value. The notional issuance price and the face value delta is transferred to the securities premium for the 3 years. Value in kind is considered as the security premium. No. What value in kind? So always whenever we issue equity share capital, we record at face value in the share capital, and the delta is always recorded in the securities premium, right? Okay, so let's do the next question and then we will wind up for the day. I'll take 5 minutes more. Entity A runs a copper mining business. Entity A has a year end of 31st March. Dividends declared on shares accrue to the employees during the 3-year period. If the condition is met, employees will receive the shares together with the dividends that have been declared on those shares during the 3-year periods up to the 31st March 2003. The entity estimated that on 1st April 2010, its shares are valued at rupees 10 each. The grant date fair value amount is the each share 10. So grant date fair value is given at 10 rupees, right? Entity A prepares annual financial statements on 31st March. On 1st of April 2010, it estimates 100 shares will vest. At the end of the first year, it revised its estimate that 780 will vest, and at the end of the 32, only 750 finally vested, right? So this is the number of shares which were expected to vest and actually vested. 750 shares vest on 31st March 2003 based on the number of employees still employed on that date, right? On 1st of April 2010, as part of the long-term incentive scheme, Entity A provisionally awards its sales employees 1,000 entities A's shares receivable on 31st March 2003. Explain the accounting treatment for the above share-based payment award based on the satisfaction of the condition that the sales employee must remain in employment until 2003. The requirement to remain in employment is a service condition and would not be reflected in the fair value of the share awards. So basically, as such, there is no complexity at all in this question, right? It is a straight away question that 800 shares will vest in the year 1, that's the expectation. 780 will vest in the year 2, that's the expectation. And in year 3, finally 750 will be vested, right? So 1, 2, 3. So number of shares, 800, 780, right? And 750, right? Fair value of the grant date is how much? 10. 10 rupees is given. And the arrangement is with whom? The employees. So grant date fair value will be considered as the fair value of the options, correct? So simply, we can perform this calculation and pass the journal entry. So for year 1, 780 shares into my 10 rupees grant date fair value into my 1 by 3. So 2600 will be the amount of expenditure recognized in year 1. 750 shares into my 10 rupees into my 2 by 3. So total expenditure minus 2600 already recognized. So 2400 in the year 2. And finally 750 into my 10 rupees into my 3 by 3, right? So total expenditure minus recognized in year 1 and year 2. So 5000 minus 2600 minus 2400. So whatever is left for year 3, so 2500 will be recognized in year 3, right? So as such, there is no complexity involved in this question. So let's see what would be the journal entries. So journal entries will straight away employee benefit expense account debit 2600 to share-based payment reserve account. Employee benefit expense account debit 2400 to share-based payment reserve account. Employee benefit expense account debit 2500 to share-based payment reserve account. Right? So these are the 3 expenditure entries which we will pass upon. Now, just to make us confused unnecessarily, if this question comes in the examination, this question is talking about the dividends declared will be paid to the employees, right? Unnecessarily, right? So Ind AS 102 doesn't deal with any dividend, right? So as such, there is nothing to do on this dividend in this case. This is just to confuse us so that we do not recognize which standard we need to apply in our question, right? Is that clear?
Yes, sir.
Okay. Very small question, and then we will end up. Passion Limited entered into an agreement with RFD on 10th of August 2002 purchasing for a machinery. So machinery is expected to be purchased. Agreement has a clause that FIL will have to settle the consideration of the machinery by issuing its equity shares. FIL agreed to clause and the order was confirmed. Machinery was supplied, wide invoice dated 25th of October 2002 and delivered on 1st of November 2000. The agreed purchase consideration was 150 lakhs and the fair value of the machinery supplied was estimated to be 160 lakhs. So invoice value is 150 lakh, but fair value of the machinery is 160 lakhs given in the question, and invoice date is 25th of October, but machinery is received on 1st of November. As agreed, FIL issued 1 lakh equity shares of the face value of rupees 100 each to RFD. As per the Ind AS 102 share-based payment, what would be the price and the date for recording this purchase? Now, what do you think? At what price you will record this machinery and on what date? Any guesses?
Fair value.
So entry would be property, plant and equipment debit 160 lakhs. Right? 160 lakhs. 2. Equity share capital 100 lakhs. 2. Securities premium 60 lakhs. Right? Why? Because standard says if there is a transaction with other than employees, then fair value would be the fair value of the asset arrived, right, or the services received. Now fair value of that asset, that is the machinery, is given in the question 160 lakhs, and standard further says that the measurement date would be the date on which the asset has actually arrived, right? So irrespective of the date of the invoicing, the date on which the machinery is received would be considered, right? So as per para 10 of the Ind AS 102, for equity settled share-based payment transactions, the entity shall measure the goods and services received and the corresponding increase in equity directly in the fair value of the goods and services received, unless the fair value cannot be measured reliably. If the entity cannot estimate the fair value of the goods received, then the entity shall measure the fair value of the equity shares which they are offering in the transaction, right? But that is not the case in our case. Fair value of the machinery is given in the question 160 lakhs. Further, as per para 7 of Ind AS 102, the control is assumed to be transferred on the date of the delivery, right, which is 1st of November. Therefore, the date of recognizing the machinery in the books of accounts would be the 1st of November, and the entry would be made or recorded at the fair value, right? So 160 lakhs, 2 equity share capital at face value of rupees 100, and the 60 rupees is the security premium. 1 lakh is the number of shares. Correct? Any questions, doubts? Super simple question is this.
Yes, sir.
Okay, so that was it from my side. I hope you enjoyed the session and session was, informative. I wish you all the very best for your examination and good.
Thank you, sir.
Session is over, Ashok ji.